On the show is Mayuresh Joshi to discuss in terms of the movers and shakers in trade today. One stock that is in focus is a Mahindra Lifespace. Mayuresh, with regards to Mahindra Lifespace, clearly a redevelopment project is what they're eyeing in Mumbai, and the potential revenue is around 500 odd crores. Firstly, your view on the stock, and secondly, in terms of the real estate space.
Good morning, Kiran. For the stock in particular, the expectation largely in terms of delivery when it comes to sales volume, the management has put a huge target, an ambitious goal rather, of almost 5,000 odd crores over the next 3 to 4 years. Now, I think the mix in which they're probably expected to achieve this is both in terms of joint development that they're probably expected to do. A few of the JDs that they have announced recently, a few of their World City Stroke SEC project actually gaining momentum, and a few of the redevelopment, as you rightly pointed out, in areas like Mumbai metropolitan region and otherwise. I think the expectation to increase their land bank and the sales potential from their land bank over the next few years, translating into better volumes and therefore into a better top line, probably seems to be an ambitious target that they've probably taken up. But a large element in terms of what they have probably delivered in the past few quarters. So you've seen some element of improvement and recovery both. My own expectation is that there should be some stability when it comes to the earnings trajectory that they probably present. So more in terms of sales velocity from new projects and more consistency in terms of numbers. And then, of course, on our O'Neill metrics, if you probably look at the EPS RS rating on the stock itself, it looks a little bit weak at this point in time. So we'll wait and watch for how the numbers play out. For the sector as a whole, I think it has held up pretty well, even in a rising interest rate scenario. A few of the pre-launches that have probably happened for a few key developers have been taken very, very well. Demand still seems to be robust. The unsold inventory might be ebbing up a little bit at this point of time, but still relatively better off at what we've seen at the pre-COVID levels. And since the unlock has probably started taking place a few quarters back, you've seen some signs of improvement happening for the sector as a whole. So wait and watch, because I think a large part of it is the price at this point of time. You'll also be looking at, as you roll over numbers, whether these companies can consistently outbeat their earnings forecast on a heavy base, specifically of last year, of the unlock sales and unlock really that happened and translated into real estate, being a key outperformer. So let's see how
So, Mayuresh, would you recommend buying any of the real estate companies, and whether a Mahindra Lifespace is a good stock to enter at current levels, or would you still say a wait and watch?
It's still a wait and watch. I think for all these reasons mentioned thereof, I think target setting is fine, but it translates into numbers.
Absolutely. Moving on, another stock from the IT space is Persistent Systems that has reported earnings. Now, overall, Mayuresh, what's your view on the earnings? Because clearly, IT as a space, what everyone was anticipating, the commentary as well as the numbers have been much better than what the street was anticipating. What do you make of this?
So even for Persistent in particular, I think the concern that was coming up before the numbers was the high exposure towards high tech, and what we've probably seen for a lot of US product store platform companies has been pretty disastrous, specifically in the US context. So high tech and BFSI, if you combine these two factors put together, contribute almost 80%. From a geographical presence, North America is 77%, and Europe, which has been a sticky area. If you read the transcripts of what TCS, Infosys had to put out, they still mentioned Europe being a very, very sticky area for them. However, Persistent in terms of delivery of numbers, constant currency almost 3.5%, dollar terms 3.6 odd percent. If you probably look at the EBIT margins of the past quarter, the EBIT margin which was getting stuck in that range of 14.3, 14.6, you see clear expansion happening here, attrition coming down. And the management sounded very, very optimistic because the new deal wins, the TCVs, were significantly better. So if you look at the top 10 client concentration in that presentation, that has actually come down to 35 odd percent. And the number of $5 million clients has actually moved from 30 to 34. So I think it's a positive element in what persistence has been putting through in terms of numbers delivery. My only concern and risk factor here is the exposure towards high tech and BFSI, which is 80%, which is significantly higher compared to any other peer within the IT bank itself. So any kind of accelerated, I mean, deacceleration in terms of order flows in the coming couple of quarters, or a significant slowdown, which is far higher than what one really expects, specifically from North America and Europe, might pull down orders, and therefore I think it might then curtail the kind of numbers delivery that Persistent has been putting up very persistently and consistently over the past few quarters. So I think again, anybody holding can hold on. It's forming a late stage base on the only. So no credit buy is there. But anybody holding can hold on. Just please monitor the near key moving averages, because if that gets breached, I think there might be some derating for these risk factors that I just mentioned.
Right, so that's with regards to Persistent. Another stock that reported earnings, Rallis India. The profits have declined, Mayuresh, by almost around 45 to 50%. Was this something that the street was watching out for, or do you think it's just a one-off? And what would you advise an investor to do with the stock?
No, I think the if you probably look at here, if you go beyond this quarter as well, in the past two quarters as well, I think the issues plaguing Rallis were on two folds. One, obviously, the high feedstock cost, which is the input inflation had clearly played out on their inventory as well. They had extreme high cost inventory in Q2. Maybe that has still persisted in Q3 at this point of time. The other elements of their business, the domestic business along with seeds. The seeds business would have done well because the Rabi acreage has been significantly higher at this point of time. There were erratic monsoons in Q2. So the expectation was that Q3 should be relatively better, both in terms of the domestic crop and the seed portfolio as well. The international portfolio, I think a few markets are still struggling at this point of time. And therefore, I think with competition still on the rise at this juncture, the expectation of not able to take significant price increases might have played out on Q3 numbers. The one solace factor that is probably expected to play out Q4 onwards will be input costs have started inching lower. So inventory will obviously be far lower than what Rallis carried out to their books in the previous 2 to 3 quarters. Their CMO business expected to ramp up in 24-25. Remainder of capex almost 150 odd crores. And therefore, I think Q4 numbers will be very, very interesting. But purely on Q3, I think the expectation was some improvement that has not happened. So I think the disappointing is clearly played out on the stock.
Right. And what would you make of a Titan? That stock has been under pressure. In fact, a lot of selling that's coming in the last couple of trading sessions with regards to a Titan. Uh, Overall, from a consumption perspective as well, uh, what have you made of the festive season, and how are you expecting a Titan to pan out?
So the commentary, I think, for Q3 has been pretty effective at this point of time. If you probably look at their three segments, and obviously jewelry and watches and wearables are the two key segments for Titan. Expectations of the wedding season this time around, I think there's a huge market where jewelry sales can catapult this time around as well. Unlock has happened, and therefore jewelry sales and specifically organized players expected to show significant improvement. Studded sales, which is important and integral component in terms of the overall margin performance, still remains very, very healthy for Titan, and the leadership position still covers both in terms of the digital presence that they have got, as well as their offline presence, which is growing at a reasonable pace. The wearable segment has held up pretty well. I think urban consumption has held up pretty well. And therefore, if you look at the return ratios, there have been no complaints. I think return ratios have been top notch. ROE is 26, 27 odd percent. Dividend yield is something which still lags Titan overall. Valuation still a little bit on the higher side. But organized players should significantly start gaining market share, specifically in terms of the implementation of e-way bills and what the government is probably looking at. Whatever budgetary announcements come through are going to be very, very interesting, Hiran, because last time I think they had very categorically mentioned in terms of import duty hikes, so on and so forth. So the organized players should benefit. So Titan leadership stock a little bit low in terms of how RS ratings over globally, but anybody holding on can.
Right. And very lastly, in terms of infrastructure and cap goods as a sector, that is showing a lot of promise now as well, and a lot of interest that has started to garner for this space. Any view on this space and any recommendations?
So looks very interesting because I think the earnings delivery has been very strong, and our expectation is that earnings delivery will continue remaining strong.
Hmm.
The general elections is happening next year around the same time in the first quarter, and therefore the order inflows at that time becomes muted because of election code conducts coming through, and therefore there might be a lot of pre-tendering of orders which might come through in the next 2 to 3 quarters. Having said that, if these order wins start coming through, case in point being Siemens, look at the quantum of order which has come through for Siemens in terms of the locomotive built up. Smart infrastructure, you're probably looking at substations, data centers, road construction. I think a significant portion can happen towards these EPC players, stroke HAM players, because I think a significant portion of what the road minister, Mr. Gadkari, has said by 24, I think a significant portion of roads will be built through. So I think these segments look very, very interesting. Input costs have started going lower. They've started inching up quite recently. It will be quite interesting to see how they pass this through. But with the working capital requirements coming down, execution timelines improving, margin profiles improving, operating leverage clearly getting played out. So yeah, I think very interesting space, both capital goods and infrastructure.
Right. And any topics there, Mayuresh?
So on our watch list, obviously we've got stocks like Siemens or an Ashoka built on cap goods, these.
Right. So two stocks we should be watching out for. Mayuresh, any disclosures that you would want to give?
So Viral, all the stocks that we've discussed, me and my family, no personal holdings at all on these fronts. But all these stocks we may have discussed with our clients. Clients may or may not have holdings in all the stocks.
Right. All right, Mayuresh. Thank you so much for speaking to us on the show and giving us your views. Thank you, participants, as well.
Thank you so much.